Hello and welcome to the Full FX Unfiltered. My name is Colin Lambert. I am publisher of the Full FX, and I'm delighted to be joined from an old friend from many years ago in the foreign exchange industry, Steve Toland, who's co-founder at TransFICC. And we're going to go way outside my comfort zone here. We're going to talk fixed income. So expect, probably the most ignorant questions you've ever heard in your life, but we'll get through it. To kick off, to be current, Steve, you just launched, obviously, I know you as a connectivity, an infrastructure firm, but you've just launched TransACT, a new platform, for want of a better word. What does it do, and why did you launch it?
Okay. Well, first off, it's nice to catch up again.
Yes.
I still feel as though I know more about FX than I do about fixed income, even though we've been doing this.
Well, I certainly do.
8 years. Yeah. And also, congrats as well on you're a startup as well. You're like us, an entrepreneur with full FX.
I'll start blushing.
Yeah. So TransACT, pretty interesting for us. I mean, it's a value-added automated trading product.
Yeah.
Our original, if you like, business plan at TransFICC was obviously to make it much easier, particularly for banks, to connect to all the fragmented different fixed income trading venues. And well, I know we're going to get into a little bit later about what's the differences between fixed income and FX. But there's a lot of venues, there's a lot of complex APIs, and our key value add is to basically connect to those venues and normalize those APIs so it's easier for our clients, mainly investment banks, to build automated trading products and risk management applications, etc. One of the original applications that one of our customers was putting together is they wanted to automate their trading flows. So fixed income, there's a lot of, it's a request for quote, it's a dominant sort of workflow trading protocol. And what one of our original bank customers originally wanted us to do is they said, if you normalize the APIs, it's much easier for us to build an automated negotiation engine. So when they get in, requests for quotes coming in from the likes of Bloomberg or TradeWeb, etc., it's a machine responding to those quotes rather than a manual trader on the desk. So we were working with some of our banks to build out the platforms to support that. As we've matured as an organization, and we've got to better understand exactly how these requests for quote protocols work, and they're pretty complex and there's a lot of them. Yeah. And we've automated a lot of our testing. We met some customers who said, actually, could you build us one of those negotiation engines rather than, we haven't got the time or bandwidth internally to do it. Yeah. So that's basically why we did it. Got approached by a couple of customers. What's changed market structure-wise in fixed income is there has been enormous growth in something called all-to-all trading. Yeah. So it used to be in the request for quote world, typically a large buy side would be going out to 3 or 5 banks and say, give us a price on these bonds, etc. What we are now seeing as anonymous all-to-all trading, basically, a buy side can actually ping out to everybody anonymously, do you want to quote me on this price? So that has really increased the volume of ticket requests. So one of our customers was like, we're getting 10,000 RFQ requests per day on one platform, and there's no way a manual desk can deal with it. And so you need to automate that trade workflow, and ignoring those trades is a missed opportunity. Yeah. So really we saw it was a coming together of us maturing as an organization and both the technology and business need with some of our bank customers. So.
Oh, and that's interesting actually, because I guess in the FX world, we went through a period some time ago. I think you were still in the industry. It was that long ago. We're not going to get into an age thing here, obviously. But we went through a period where the buy side would just put out a quote to everybody. Yeah. And then they realised that their execution quality and their liquidity quality actually disappeared. It sounds quite interesting to me that in fixed income they're still going to everybody, and it is a request. And you can say, oh, you don't have to quote me if you don't want to, but we all know that everyone's going to want to quote that ticket. It kind of shows that we're a little bit behind, and you mentioned there FX and fixed income. I mean, what nuances are we seeing? Where are the differences and where are the similarities? Because that's a similarity, but from maybe a decade and a bit ago.
Exactly. I think what is very different is fixed income is I would argue way behind FX in terms of automation. So I obviously think of obviously I used to be at sales at EBS, and when I joined EBS in the early 2000s, we were an electronic market, but virtually every order was being input on one of the old keypads with the keys removed. By the time I left in like 2012. Nearly all the orders were being input by API. Some of it may be from an aggregator and a human behind it, but everything was coming in through. Fixed income has nowhere near as mature in that, if you like, automation sort of life cycle, if you like. And part of the reason for that is because the instruments are more fragmented by asset class, and then it's more complex workflows. So it's not. FX is a very big market, but a lot of people are trading euro dollar. We've got government bonds, corporate bonds, interest rate swaps. These are all different asset classes. And then what you've got is, because they're more complex instruments in terms of people tend to haggle back and forth a lot more than in obviously the FX world. Lots of banks, either direct or through a multi-platform, are streaming prices direct to customers, which click and trade. So not as much of that going on in fixed income because of the fragmentation of asset class, and you need to negotiate back and forth a bit more. And so that's sort of where I feel that you could say fixed income is behind, but there's some good reason for that.
Yeah. I mean, are trade sizes coming down with more electronification? So, which I guess would be another thing where it's following FX.
Yeah, I mean, typically, it's pretty interesting. What does amaze me is how many trades in fixed income are still voice. I mean, you can't. Surely you can't do that. It's not going to work anymore. But then,
if you're talking about a pretty rare corporate bond that trades maybe once a day,
or a huge size interest rate swap, which is is not one of the standard tenors, etc. It's a bilateral negotiation in big size. That's going to be voice or Bloomberg chat, etc., and then they input it onto an electronic platform to record it, etc. So still quite a lot of that goes on. But to your point, with the growth of electronic trading, with the growth of all-to-all markets, also what we've actually had is quite in fixed income. We've got high-frequency market makers coming into the market, but they're different ones. There are ones who, hedge funds who really have a franchise in trading ETFs. And so they, constituents of the ETFs, they basically want to trade all that. And that creates a lot more volume of smaller size tickets. So same thing we saw in FX, but for slightly different reasons. Ticket size is definitely coming down.
So you're going to then, clearly in the next couple of years, we could sit back in this room again in front of the camera and go, okay, so everyone's complaining about market quality because
that feels like the same.
Because it does sound to me like, okay, if you've got market makers in smaller amounts, are they going to be obviously more data's being generated, more automated trading? Is this actually going to lead to some of the challenges that some of the platforms in FX faced a decade ago?
Without a doubt, you're going to have manual traders who says, this market is not as good a quality. I don't like it anymore because there's more counterparts and there's smaller ticket size and spreads are tighter. There's more transparency coming in. But as you move into electronic automated markets, those things happen, and you have to figure out the competition's going that way. So you've got to basically, if you're a market maker in one of those electronic markets, you've got to work out how you're going to automate and how you're going to get efficient. And that's it's just sort of a natural evolution, I would.
The reality is change is going to happen.
It is. If you don't do it, someone else will.
Somebody much cleverer than me said once, the only constant is change. No idea who it was. If you happen to be a viewer, sorry. But so the wider fixed income market, are they the key trends that you would say are being debated in terms of market structure? Are there other areas that people are looking at?
There is definitely more automation coming, but it's a long way behind. One thing that is not very mature in the fixed income market is this direct bilateral trading, which we have very well established in FX. Lots of banks stream prices direct to customers. People trade direct. Less of that happens in, very little of that really happens in fixed income, partly for regulatory reasons. People got to put dealers in competition, needs to go through a regulated venue. And then also because of what we talked about earlier, more complex asset classes, workflows, well, everyone says they do requests for quote. The requests for quotes between government bonds, corporate bonds, IRS are all called different things, and there's all sub workflows and it's like, some of it is like, why we have these level of complexity, but it's sort of market convention. And so that is less well established. Direct trading is a lot less prevalent in fixed income as it is in FX, but it's coming.
I think it inevitably has to, because the market structure you're describing, the evolution you're describing tells me that market impact and execution quality will become a much bigger issue for the buy side in fixed income than maybe it was previously, when you say they could just go to their dealer. Dealers aren't holding inventory now. They've got to split up tickets in smaller amounts. All of a sudden we get into hang on, I think I've heard this argument before.
Very similar. Very similar in terms of that market evolution. What I think is a little bit different is in terms of the some of the players. So obviously, large banks are, they're dealers they've got natural franchises in government bonds and some corporate bonds, etc. On the some of the high frequency market makers, as I would call them in the FX market, some of them have got into fixed income and some of them haven't. And some of that is due to there is less sources of transparent market data. You can't, if you think about those prevalence of those RFQ protocols, what's happening is you've got a buy side doing a mini auction with 2 or 3 counterparties. And not everyone sees that. In the US, there's something called trace, so you get to be a published, tape comes out of all, of all data, but it's delayed. It's not real time for big ticket stuff, etc. And then we've got a similar version coming in Europe. It's called the consolidated tape, but it doesn't exist yet. And there's huge debates going on with regulators at the moment about how it's going to look and feel and how they're going to do deferrals of large size trades. But if you're a high frequency market maker and you're saying, well, FX has worked for us very well, and we've done US Treasuries, but why don't we do corporate bonds? You go, well, where am I going to get some market data? Where am I going to get some market data for this stuff? And it's pretty hard.
It's an interesting one, though, isn't it? Because I think there was a stat. I mean, it's a very old stat, and if you thought I was outside my comfort zone on fixed income, wait for this one. I read a stat that like 30% of equities volume on the NYSE was actually dark.
But, it would surprise me.
So you've got this challenge where the actual end user doesn't really want the market transparency, but the new generation of LPs absolutely wants the transparency. And because you don't have that bilateral client-dealer relationship, both can pursue their own paths, can't they?
Yeah, exactly. And then, obviously there are some players, one of the I would highlight is Jane Street. So they have become very big in the fixed income market, but it really is based on this ETF trading. They really have been market leaders in that. And I would argue that they've partly helped change the market structure in fixed income. But I don't remember Jane Street being a big name when I was doing FX. So, different players.
Oh, new players come in and new players go, don't they? Obviously, what we've kind of edged into everyone's favourite area there, regulation. And if I would ever have sympathy for anybody outside of FX, it probably would be the fixed income world, because it seems to me the regulatory burden there is quite serious. And part of that, we mentioned the tape. I have real problem. I'm glad to hear there's a big debate going around how the tape should work. Because I think there are enough markets that have been blown up by regulation as there are actually been improved by it, I would argue. So what's really happening in that regulatory space that's driving the debate in the fixed income?
Well, there's 3 things I would highlight. So there has been something called the, which affects FX as well, but lots of debates in fixed income is the trading perimeter. What defines a venue? That gets a bit, you can debate that one long into the night over a beer. So that's been going on. Consolidated tape is probably the most topical thing I would say in the fixed income space. Obviously, they're bringing in an equity consolidated tape as well, and it's basically what is interesting is there's going to be tender auctions going on in Europe and the UK, and effectively, I mean, theoretically, you could have two different tape providers in each jurisdiction for same asset class, and it's like crazy, you know.
So the whole idea is it's called a consolidated tape, and it's already being fragmented.
Yes. But essentially that train is in motion. It's going to happen.
Yeah.
I mean, I think, you know, obviously there's real concern on some market makers, you know, that you want transparency to, you know, essentially, you know, partly reduce spreads, make markets more open, it attract more people into the market. Yeah. But you don't want it to be where it basically makes it untenable to trade. Remember, these are quite often illiquid products. Yeah. And then people are like, you know, these are hard things to trade, and you know, I need to do them in a non-transparent environment. Yeah. So that, you know, we think technology-wise, that's something that we can help build, and we've been quite open about it as well. Yep. But we're sort of taking a back seat as to what the rules should be for deferrals. You know, there's industry trade bodies, and there's obviously banks and buy side they actually trade the instruments, and they've got a better view on this than we have. So that's so I think that is clearly the most topical regulatory thing going on in fixed income at the moment.
Because ultimately, that tape doesn't really help promote the holding of risk. Yeah, I mean, in FX terms, we tried a tape and it didn't really work. Yeah. Because everyone's going, well, the last thing I need is, I've just quoted, I'm going to be in Scandinavia next week, Euro stocky, 3 months, 25 delta jam roll. Yeah. Whatever it's called these days. And the last thing I need, because that's going to take me days to get out of that risk, the last thing I need is that appearing on the tape.
Yeah, I mean, and there's different, for some instruments, they're actually, I think the AFME, who's one of the industry bodies, basically said that they were recommending for some instruments it should be a delayed 4 weeks. Yeah. You know, but it depends, you know, obviously what the instrument is, etc., and its liquidity profile. Just on one other regulatory thing I would say that is important for banks and vendors, as you know, we would call ourselves an infrastructure, a technology infrastructure vendor for banks, etc. Banks who deem to be strategically important have got to comply with some new regulation in Europe called DORA, which is the Digital Operations Resiliency Act. But what that regulation, and it's EU law, it's coming in January next year, and you know, I only heard about it 3 months ago, and I was like, I better look this up on the internet. I don't know what it is. But what it is saying is, if you're a strategically important institution trading these instruments, etc., you must look at your resilience capabilities for things like DR failover, and more particularly, what makes this more timely is cyberware ransom attacks. That is quite scary stuff. And I actually think, obviously it's been public with some venues being off air for a couple of weeks. I mean, that is scary stuff. And so what the regulators are doing is putting it over to the banks and saying, you must look at your internal systems, and you must also look at the vendors that you use, and have you thought about, diversity of systems and processes, etc. So, if one venue or one vendor or one asset class goes off air, what are you going to do about it? And you've got to think about that. So I think that is it's very high level regulation, but it's quite a big impact on banks. And they're my customers, but I empathise with banks at times. Like, I don't know how they get to do any trading because they're dealing with more, we've got more meetings on regulation. What are we all going to do about this? And it adds to the bank's costs. So it's sort of, it's a double-edged sword for someone like us. We like to think of ourselves as an innovative vendor to banks. And they say, I need some innovative stuff, but I
really need is this.
I've been told by the regulator I've got to build this. So it works both ways for us.
I guess to close out, in FX, and say, excuse my ignorance if it is ignorance,
Yeah.
it probably is, as everyone out there knows. In FX, we have the BIS Triennial Survey. And so we can actually benchmark activity in the market. We have the semi-annual FX committee surveys where we can benchmark activity in the market. Is there such a thing as that, or is this what the tape will bring, would be a benchmark of volumes in fixed income markets? And generally speaking, are fixed income volumes actually going up over the last couple of years?
Volumes are going up, but we tend to benchmark. I mean, there's organisations like ICMA put out studies. But what we think actually is a more interesting benchmark is actually you've got some very large venues who are public, so TradeWeb and Market Access, etc., and they publish their sort of volumes by asset class every quarter. Yeah. And obviously we tend to connect more to electronic trading, but venues. So that's So if you look at that over time, and obviously there's all this fragmentation of asset class. Yeah. But there is no doubt, electronic volumes are going up. Okay. And it's across the board. It's not, different asset classes are at different maturity levels, but even probably the least electronic asset class, repo, is rapidly going electronic. Yeah. I mean, so we tend to look at those benchmarks a bit more, partly because it's all public, it's easy to get hold of.
Yes, yeah. So just finally then, obviously we started off with TransACT. What sort of areas, without giving away any state secrets of course, but what sort of areas do you see Transf evolving into or moving into?
It's interesting. So I mean, I guess as an organisation, we've matured a little bit. So to start with, just trying to can we build something and can we get a customer? It's like we just need a. Yeah. So obviously, we've got a few customers now. We've moved on from building the just the sort of like the back end API stuff. So as well as TransACT, we've got obviously a aggregated GUI for bank traders for interest rate swaps. US credit is next, and that's going to go to government bonds. We're in the infrastructure hosting business. Then that wasn't originally part of the plan. But if you're a SaaS model, if you're hosting everything centrally, you've got to put it on servers. And there's a requirement, obviously, for certain markets. There's a low latency requirement, just like FX. So you need to be colo, it needs to be fast. And there's also economies of scale by building out your own stuff and rather than something else. So we're sort of in that data center hosting business, partly because all our customers, they also need full DR failover. Yeah. So we're sort of in that business as well, although that wasn't part of the original plan. It's just you need to build it to actually deliver a sort of a service. So and then we're just kicking off doing stuff on the buy side. That's pretty new. Couple of customers and but a long way for us to go on that side.
Well, I mean, I remember when you left FX to go to the dark side. And saying he'll be back in 2 years.
I said I may need your help to get back in when it all goes wrong. Yeah.
I know 8 years on. It's quite remarkable. Great that it's going well. Congratulations. It's nice to see entrepreneurs actually get out there and do well. Thanks for the update on the fixed income markets. As always, great to talk to you, and hopefully we'll do it again soon.
All right. Thanks, Colin. It's great.
Yeah. Thanks, everyone, for watching. We'll be back again very soon.